Well, China is going through heck and back, and the Federal Reserve has, another little Nikki Leaks leak, and we'll talk about both in this video as well as a few other things. So, first, what's interesting that's going on in China is that China has kind of ripped the bandage off on COVID zero policies. But this is really fascinating because China didn't really prepare as much as they should have for COVID. At least this is what we're hearing from not just US based reporters, but also Chinese based reporting firms, which usually it seems like the Chinese government has a pretty good control of Chinese media. But let's put it this way. People are so fearful because entire offices and families, anecdotally, are staying home because everybody's sick that people are lining up at pharmacies to buy flu medication and fever medication. And they're starting to ration this in China, which is a complete U turn from nearly 3 years of COVID zero policies in China. Some are now saying that cold and flu medication is totally sold out, that, if you don't look sick, you're only allowed to buy one box. You can't stock up on flu and cold medicine. And that now Paxlovid was put up for sale, which is an antiviral COVID drug that was put up for sale in China. And within 30 minutes, it was completely sold out online. There are a small note on Paxlovid. Some people talk about like a COVID rebound after taking Paxlovid. Other people say, no, any potential person who gets COVID has the potential for a COVID rebound, whether you take that or not. Who knows? But the point is, China has only about half of its population over 80 vaccinated. They also use Chinese vaccines, which we have less data on the efficacy of those. They also waited way too long to build and staff new ICUs. So now you've got organizations like The Economist suggesting we could see 1.5 million deaths in China from COVID and potentially a peak in January. And consider this, we already think that China is in a depression. And that's scary. We already think that China is misleading us on economic data. You've got three huge pressures. You've got demand dropping off a cliff, more people working from home because they're afraid of getting COVID, or everybody's already got COVID around them. You don't really have herd immunity in China yet because you've had 3 years of sheltering people. Which, by the way, all this work from home and contracting demand is definitely not good for auto manufacturers. I mean, no surprise, it's not good for anyone really in China. Supply shocks are another issue because can't make stuff at a factory from home. And then, of course, now we're expecting weaker growth in China in 2023, especially as we go into 2023 with basically letting COVID rip, which probably should have adopted what other countries did earlier, which was let's prepare, let's get our hospitals ready, let's get our doctors ready, let's stock up on cold and flu medication, let's stock up on everything we need, and then let it rip. China's kind of just like, yeah, COVID zero is a little exhausting. Yeah, just forget about it. And this was on December 7th. They've kind of started pulling back on a lot of these restrictions. It's kind of just like, yeah, go for it, whatever you want. And people are like, I'm going to stay home because everybody's got COVID. So they're like self-COVID zeroing, although that's not really working because everybody's getting sick. They're even like apparently running out on simple things like dexamethasone. This is a low-cost steroid. I remember when Donald Trump was sick, he took this, and then there were headlines talking about how he was taking a powerful steroid, and then you had flip sides of nurses going, yeah, we've been using that on everybody, and this was back in the early days of COVID where it was sort of like nobody really knew. Hospitals didn't really knew. They're kind of like, let's try this. World Health Organization says that China lacks herd immunity, low vaccination rates for the elderly. Again, only half of those over 80, and could end up seeing very tough times ahead. The IMF is calling for a 20% drop in real estate prices next year. Yikes. So then we've got to talk about the Federal Reserve. So yesterday we talked about the Federal Reserve in a video that I think is very important. It's the Federal Reserve was duped video. Very, very important if you haven't seen that yet. In fact, I tweeted a little bit about how the Federal Reserve was being duped. And Kathy Wood retweeted part of it, which I thought was really cool. I'll pull up that tweet and show you. But basically, I encourage you to watch the video so you can really internalize it. But basically, the Fed's looking at BLS data, which the Philadelphia Fed is coming out and saying, wait a minute, this data we're getting is just wrong. Now, we don't necessarily want to go tinfoil hat and say, oh, it's definitely rigged for politics and political reasons or whatever, right? The difference between the establishment and household surveys. But we're not actually creating as many jobs as we think we are. And when the Philadelphia Fed is saying that, it's kind of like, wait a minute, this is really interesting, right? Because this could potentially be an indicator that if the Fed's starting to realize, ooh, that's maybe a sign that maybe they'll relax a little bit. Who knows though? Okay, so let's I'll show you Cathie Wood's tweet in a moment, but hold on a second. This interview is just starting here. Let's hop on over to this for a moment.
The move up in to the restrictive rate that was even more restrictive.
This is a Federal Reserve person, by the way. Fed speak starts now.
Yeah, probably harder than you thought it would just a few months ago. With these dots, with this position now, do you think you finally caught up to where you need to be?
Well, I think we're well on our way there. And I think when you look at the kind of the central tendency of the dots, my colleagues expect the Fed funds rate to get to, say, 5 to 5.5% next year. I think that gets us into that hopefully sufficiently restrictive stance of policy that will bring inflation back to 2%. So I am getting increasingly confident that we're getting closer to that point, but obviously we have to watch the data. The inflation and other data have surprised us, and we need to be on the lookout for that. But I do feel we're getting to a better place.
Now, just about 2 weeks ago, you said that the Fed funds rate has to get above the inflation rate to bring down inflation. How far above inflation does it have to get?
Well, that's the question, right? In way we talk about this as in terms of sufficiently restrictive to bring inflation back to 2%. So to me, it's really about getting it high enough, and of course keeping it high for a while, for enough time to really see clear signs inflation is moving back down on the way to 2%. My view is you have to think about real interest rates, as you said. If you look at, again, the median dots, if you will, in the economic projections that we just put out, you see the real Fed funds rate, say the Fed funds rate minus the core PC inflation, around 1.5%. I think that's a reasonable view of restrictive. Again, whether it's sufficiently restrictive, we'll have to watch the data and see. But I think that's, to me, basically where I'm thinking right now.
Now, there's many top economists, former Fed officials even, who are saying it's looking more and more like you are going to have to go higher, even than where you are now. Maybe something like 6, maybe something heading towards 7%. Can you see that happening? And what circumstances, what would be happening for that? You have to go.
That'd be bad.
Well, that's definitely not my baseline, as I just indicated. I don't think we'll need to get real interest rates that high. But of course, things could happen differently than we expect, and would have to, especially around inflation, but also how strong is the economy, even with higher interest rates? Do we still have these imbalances between supply and demand? Right now, I mean, PC inflation is 6% over the last 12 months. And we have clear signs that demand exceeds supply in our economy and our labor market. So to me, the question of how high we have to get to is really going to depend on what we see in inflation and the supply and demand imbalance. Again, my base case is we don't have to get that high. I think we have some favorable developments underway, things that we've been talking about for a long time. Supply chains definitely are getting better around the world. We're seeing that in a lot of different data. And we're also seeing, some of the goods prices and import prices come down, a reversal of some of those pandemic era things that pushed up inflation. So we've got a few factors I think are going to bring inflation down to 3 to 3.5% next year. But then the real issue is how do we get it all the way to 2?
Of course it is, but right there though, is the message from Wednesday that, and this ties in with, if you might have to go higher, is the message that if it's not coming down as we expect, then we are clearly open to going higher, taking the next step?
Well, we're going to have to do what's necessary, again, sufficiently restrictive to bring inflation down to 2%. And it could be higher than what we've written down. And we have had to increase our interest rate projections as the data have come in. The inflation has been stubbornly high, as many people have said. And we've seen the economy remain very resilient to higher interest rates. Remember, the unemployment rate is 3.7%. Some signs of slowing demand for labor, but still a very, very strong imbalance between supply and demand right now.
There were 2 surprisingly good CPI reports going into this meeting. And so a lot of people thought, well, that's good news for the Fed. Maybe they're not going to be quite as aggressive. But at the same time, what happened? 2023 inflation forecast, boom, goes up. Mm-hmm. How did this happen? What's guiding your view on inflation? Again, two good surprises on CPI, and yet the PCE core and PCE overall still expected to rise.
Right. And again, relative to say our earlier projections in September, I think that you really have to think about what's happening in the inflation data. So we are seeing good news. I like good news on inflation reports. A lot of that's in the goods areas and some of the areas we've been long expecting those inflation rates to come down. So that wasn't so, that's something that we've been expecting to see as part of the baseline forecast. Where inflation is still high is in these core services areas, the areas that, are probably going to be more persistent and really reflect the imbalance between supply and demand in the labor market and in our overall economy. So sure, we are seeing some good signs on goods and some other categories. I'm also seeing some good signs in the rents for new leases of apartments and houses. So, that inflation should eventually start coming down later in the latter part of next year. But again, in these other core services, that inflation rate is still high. And that really gets to how strong the labor market is. So sure, some good news, but the underlying issue of core services inflation is still very much there.
Well, your forecast for unemployment next year is a big jump, right? You see it much weaker, up to almost full percentage point from what you're looking at in September, 4.6%. You're looking for GDP to be much weaker than you thought 3 months ago, down to 0.5%. So is this the kind of forecast that is consistent with a soft landing? Is it consistent with something maybe not quite that good?
Well, I think it's an economy that's continuing to grow. As you pointed out, the median dot is around 0.5% growth for this year and for next year. So as an economy that's growing, it's an economy where the unemployment rate is rising somewhat. As you mentioned, the median will be at 4.6% at the end of next year. So I don't see this as a recession. We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Is the retail sales were weak across the board pretty much. Is this a canary in the coal mine for where the economy is heading and a part of the economy you want to get final demand down?
Right.
Is this maybe an early sign that you're succeeding?
Well, we have to look at all of the data on that. And obviously where we're seeing the signs of the economy slowing is in the housing sector and now in manufacturing. Consumer spending has been kind of jumping around a bit month to month, quarter to quarter. It's actually been more up until this latest data, more resilient perhaps than I was expecting. So we just have to, go through all that data and really see kind of the underlying strength in the economy. That data doesn't change my basic view that we're going to have an economy growing modestly over the next year.
You're talking about the services X housing, right? Core services X housing seems like it's the key indicator now. We have to see that coming down for the Fed to be convinced that inflation's moving in the right direction.
Well, I think that it is most closely related in many ways to the state of the labor market and domestic price pressures. Some of these other categories, which of course are part of the inflation index, we don't ignore any of them, but they really are about the special factors, car prices that skyrocketed, transportation costs and things like that. And then I think the housing market, we're already seeing some good indicators eventually of that coming down. So this is the area that's not coming down, and we definitely needed to see it coming down to get to that 2% inflation goal.
So a lot of focus on labor and wages in that part of it, right? That's what's important. That's what Chair Powell pointed out this week. So do you think that there are signs of a wage price spiral right now? Is that one of your concerns? Again, and when you look at CPI.
Bad phrase, very bad.
That's good news, but boy, oh boy, the trend is still too much up for us.
Yeah. So I don't see any signs of a wage price spiral of the kind that we saw in the 70s. A couple data points I'd point to. One is inflation expectations have been coming down. They've been really well anchored for longer run expectations, but we've also seen in our New York Fed survey and in the Michigan survey, shorter term inflation expectations coming down. So I think that we're not seeing that kind of dynamic kick in of people expecting higher inflation, demanding higher wage increases because of that. The other is, I really see wages as kind of the barometer, one of the barometers of the strength of the labor market about demand and supply. Right. I think wage growth has been very high because labor demand has been really strong relative to available supply. As labor demand and supply get better in better balance, I think the wage gains will be more consistent with longer term trends and our 2%.
What do you make of the Southwest Airlines contract that was just signed? They're going to get a 24% increase in wages over the next 4 years, excuse me. Is that a concern?
Well, we're seeing a lot of adjustment in wages for around the country. I'm not going to point to any specific one. I mean, again, wage increases right now, given where inflation has been, given where the labor market is, are still quite high. And so we're watching those indicators.
Okay.
To me, it's really about tracking how the economy
Okay.
does over the next year, labor demand, supply, and wages.
I want to focus on financial conditions. Chair Powell noting that the markets and the Fed seem to be working at cross purposes a lot of the time lately. Are you concerned about this push-pull between the Fed and where it's trying to lead and where the markets want to go?
Well, I think we need to be, and we are being clear on what we're going to achieve, and how we're going to achieve it. I think that, the economic projections and the dot plot we put out provide a nice roadmap of how we're seeing the economy and monetary policy over the next couple of years. And obviously, financial conditions depend on a lot of other things than just monetary policy. So I always look at a broad set of financial conditions, understand how that feeds into our outlook. Right now, I know that, some market participants clearly are more optimistic about inflation coming down. I look at the real interest rates implied by that. I think pretty much everyone understands that real interest rates need to get restricted and stay there for a while.
Is that an issue for the Fed, though, when you're trying to move policy in a certain direction? Right? You want to tighten. And if the markets rally and then financial conditions soften, for whatever interpretation markets are taking, is that an issue? Does that make the job harder?
It doesn't make the job harder, but it's just another one of those factors, like what's happening in the global economy, a lot of things that have to feed into our view of where the economy is going. And then what we need to do. Clearly, to the extent that financial conditions have tightened quite a bit over the past year, consistent with our moving towards a restrictive stance of policy, that's an important part of the transmission of monetary policy of the economy.
In keeping with that, I want to ask you one last question, because we're hearing this a lot, that the Fed let inflation get out of control for whatever reason, and that this may have eroded the credibility of the Fed with the markets. Well, how do you respond to that?
Well, we're absolutely committed to getting inflation back to our 2% goal, and we're acting in that way. I think we're communicating in that way. So I don't think we've lost the credibility, of course, at all. I do think that, we are completely united in our focus on getting inflation back to 2%. We've taken extraordinarily strong policy actions over the past year. And as we've shown, we're going to continue to take the actions that are needed to get inflation back to 2%. Price stability is absolutely essential for a strong economy in the long run. We need to get that done, and we will.
All right. Well, 2023, here it comes. President John Williams, thank you so much for joining.
Yeah, just so you know, that's the New York Fed building, by the way. I saw some comments. People are like, what are they, in a hallway? Yes, they are. That's the bottom of the New York Fed building, which is actually a really difficult building to get into. It's pretty glorious. So this is the beginning of Fed speak here. And really, one of the things that the biggest highlights I got out of this here were, look, I love hearing no signs of the 70s level wage price spiral. And one of the reasons the Fed believes no wage price spiral is this idea that expectations are coming down for inflation. But unfortunately, I think what the Fed is doing now is they're not actually purposefully suggesting, oh, hey, look, reports are coming in good. This is great. We're on our way to getting inflation down. Instead, they're like, we're going to keep going. I think they're doing that because they don't want expectations to run up all of a sudden. And by kind of keeping their foot on the back of the neck longer than they should, so to speak, they're really sending this message to markets that, see, we told you we go to 2%. And so expectations are falling. And now they're falling faster because markets are like, oh my gosh, they're not going to stop. We thought they would let up. They're not going to stop. Well, then inflation's definitely going to go down. We could go to deflation. And so they want to see these inflation expectations plummet. Remember, they've come down. We're at the second lowest point on the bond market's expectations of inflation all year. But when you look at today's low and you compare it to 2018's high, we're higher than that high. So 2018's here. We're above it. So we're still up on expectations when you go all the way back to 18. And what were they doing in 18? They were hiking. Now, in fairness, they only hiked to 2.5%, and markets basically had a hissy fit. But it's somewhat interesting to see how they sort of have to play this game where they're purposefully staying a little aggressive for longer, even though the data is finally moving in the direction to reiterate the nature of transitoriness of inflation, or I should say the eventual transitoriness. Now, something that I like looking at is they're talking about core services and getting core services down. Yeah. And look, we've got some work to do here. You've got miscellaneous personal services still up at a 6% annualized rate. Financial services are down. Goldman Sachs just announced laying off 4,000 people. That's like 10 times as much as was expected. Personal services still running here at about 4.8% on an annualized basis. That actually has a decent weight here, 1.3%. I mean, it doesn't hold a candle to real estate at like 32%, right? Education services, 5% weight, only 1.2% annualized. That's not bad. Remember, I'm multiplying by 12 to get that. Telephone services actually negative. Delivery services negative. Although postage and delivery, so postage running hot here at 3.6, that's a little high. But, you get fluctuations like that. I mean, look at that. Why is it up 3.6% in a month? But over here, it was only up tenths of percents. So you get these fluctuations, especially around the holidays. Probably fewer postage workers, so they raise prices. Transportation services here, 0.8%. I kind of expect these things to start plummeting. Just look at the Baltic Freight Index here. You can't because I'm in the way. But here's a chart of Baltic Freight. And look at these prices to ship a container. I mean, look at where we were. We were at, $1,500, $1,200-$1,300 to ship a container. Right now, we're still at $2,100. So we're still elevated. Like if you invested in container shipping pricing, over here, March 20th at $1,377, today, you'd be up at, you'd be up 54%. At $2,100. That's not bad for investing in container shipping prices, right? If that was something that you could invest in, which you can with contracts and stuff like that, but it's not like there's a ticker for that. Of course, there are companies, but anyway, this is really interesting. You've seen this collapse from well over 10,000 when we had massive shortages. I mean, you had companies chartering their own ships because it was so expensive to ship goods. To now just something that's plummeting. And this plummet is great. Like this is what we want to see. We want to see this continue to happen. Medical care services shifted down. That's great. Medical care services, almost a 7% weight there. Awesome. So we want to continue to see that. But I mean, nothing compares to that rent of shelter weight, that 32% on CPI, 25% on PCE. Pretty critical. So before we started with Fed Speak, actually, you know what? Let's actually finish with Fed Speak first. Let's wrap up Fed Speak. That is, Nick T posted an article again on Fed Speak, and let's go ahead and grab some Nick T information here. So one of the things, okay, there are a few things here. So Nick T from the Wall Street Journal, I love it when he posts because I feel like he's basically the mouthpiece of the Fed. We've got here no decision yet on the upcoming meetings for whether we're going with a 50 basis point hike or even a 25. There were some hints that maybe a 25 could come. Although I think the big thing that really hit fear was this idea, no talk about rate cuts in 2023 and waiting until 2024. I think that set some nervousness off in the market, especially since data's starting to come in pretty weak. And we're like, wait a minute, you are going to push us into a recession. You're going to force a recession to destroy those inflation expectations. And that appears to be exactly what they're doing. So we look at the Nick T article, and I think the most interesting part was the talk, obviously, certainly about core services, core prices, rather, not just core services, but core prices, which include core services, increased at a 4.3% annualized rate. The lowest reading in more than a year. So this is good. We're actually on the right trajectory here, which is great. Another thing for the real estate market, and I've been talking about this in some real estate videos, is people are like, oh my gosh, there's a shortage of houses still. Oh, hold on a second. Sharp slowdown in the growth of new households. People aren't going out, leaving their parents' homes, or elderly people are moving in with their family, right? Not good. Look at Lennar's earnings. Terrible. I mean, this 23 to 24% write down in backlog pricing, 9.6% quarter over quarter cut in prices. I mean, that's huge. It's a huge quarterly drop. Wage growth, they say here, has not shown any meaningful signs yet of a slowdown, particularly as companies offer higher wages to attract new workers. And so what I wrote here is I'm talking about within the last 2 days, seen an airline rotation and a red flag in airlines potentially ending up weaker than we expect. What's this guy saying about real estate? Hold on a second.
Demand for all kinds of goods and rental housing or even homes for purchase, there was always an element of seasonality. So rents and home prices usually go down in the back half of the year. Our data shows over 10 years, almost all of the rent growth is in the first half of the year. And that's because most people either buy a home or rent a home in advance of the school year. Now, that being said, we are seeing a deceleration compared to the very torrid rent growth and home price appreciation earlier in the year. But I do want to point out, because you referenced job losses, is that job losses and the fear of recession, which is in the media and the news every day, is probably having a dampening effect on household formation. But when we look at the long-term fundamentals, because we're not trading these homes, we're investing in them long-term, those fundamentals look really great. As the millennials move into the peak household formation period, they overwhelmingly want a single-family home.
As you raise capital, you think about when to deploy.
Yeah, well, that'll be in the future after this crash. I mean, think about it. Who is going to buy, what millennial is going to say in April of 2023, honey, let's go buy a home. Home prices are only down 15% year over year. It ain't happening. People, I think one thing people have to remember is real estate is not like stocks. I don't care how much you know about stocks. When a buyer walks into an open house, they're a Gen Z, a millennial, they're 40, they're 50, they're 60. I don't care who it is. If they've never bought a house before, they are scared. In an appreciating market, they're scared. Imagine how first-time homebuyers are going to be. It's terrible when prices are plummeting year over year, and then they've never bought a home before. Dude, people will talk themselves out of buying so fast. That pain's going to extend next year. I really believe it. So we'll see. Anyway, it's not like stocks where you do have retail dip buying, where it's like, oh, prices are down. Okay, yeah, the smart thing to do is buy the dip. All right, fine. It's real estate isn't like that. So it's going to be very interesting. Yeah. Now, one last thing on the Fed. It is very interesting to me that the Fed's talking about how much these inflation expectations have come down. I really think they almost want to overshoot, and before they U-turn, they want to see inflation expectations are below those 2018 levels. So I think that's fascinating. I do think that wage growth, the expose by the Philly Fed that we pointed out yesterday is a big deal. But I also think this airline rotation by Delta, JetBlue, this concern about forward demand is a big deal for helping us bring down some of those wage inflation concerns. We do have massive options expiration today in the market, so do expect a lot of volatility. $4 trillion in option expirations expected today, quad witching. This only happens 4 times a year, basically once every quarter. And you're going through this options expiration today, going into one of the lowest liquidity times that we've seen in quite a while. So expect some extra volatility today. And so if you're playing some volatility plays like we are in stocks and psych, probably have to wait until Monday or Tuesday to actually see vol fall. But if you want to play some high vol plays today, hey, could be interesting. We'll look at the charts when the market opens. So Cathie Wood, by the way, wanted to talk about this. Cathie Wood liked and retweeted a tweet of mine. That's awesome. I'll take both. Anyway, shout out to Cathie here. So let me give you the thread here. So I'll go to tweets and replies, and I'll give you the whole thread. I think it's quite an important thread. So here we go. Right, this is where is it? Twitter threads are annoying. There it is. Here we go. Massive rate cuts coming. The Fed is likely to cut rates starting in Q2, Q3 23 under the 2020 policy of flexible average inflation targeting. That's called FATE. Kind of ironic that they came out with something called FATE right before, one of the nastiest stock market pullbacks and worst experiences of monetary policy, overprinting and then potentially over tightening, but whatever. And via this policy of FATE, the Fed can allow inflation to take until 2026. So these are numbers that I put together on PCE headline. Can take until 2026 to fall to 2% and still have average inflation of 2.18% over 2010 to 2020, 30 actually. So over that 20-year period, they could say, look, we've achieved average 2% headline PCE inflation, even if they take until 2026 to bring inflation to 2%. In my opinion, that's actually something that's bullish. Fed obviously has three conditions. We've talked about that before: goods deflation, leading rental deflation, wage growth stability. Fed talked about the Philadelphia Fed survey over here. Unfortunately, the Fed's likely to keep pressure on the wound longer. Sadly, much like the Fed was still printing money while inflation was 8.5% in March. How insane is that? That they were still printing money while inflation was 8.5% in March, and they'll likely keep rates too high too long. Therefore, Elon Musk is likely right when he says a deepening recession, right? So I give some ticker symbols here, and I talk about how calls for the Fed to change their inflation target to 3% are really unnecessary, especially because their credibility, I think, is at stake. We just saw Fed speak John Williams over here talk about how, oh, no, we haven't lost any credibility. Yeah, right. They've got some credibility work to do. Anyway, this is what Kathy tweeted and retweeted and liked. I believe the Fed will most likely begin cutting rates for fear of actually underachieving 2% average headline PCE inflation, given the deepening synchronous global recession, unofficial depression, and unofficial depression in China. I support Kathy's argument of substantially declining prices. So that's kind of cool. But yeah, I mean, I think there's a real potential for that. So that doesn't mean, oh, YOLO all in, time to go up in margin, right? I think, like what I mentioned this yesterday in the comment section, honestly, sometimes I wonder, like, why do I go down there? But somebody's like, well, this is like the 2,747th flip-flop. And it's like, no, this is actually, if you watch the video, this is actually like a really long chapter book. And while like the headlines of the chapters may have really like exciting titles, this is all like one long story, right? This is all one long story. Fed nasty U-turn to the dark side in January and December of last year. Waiting now for the positive U-turn. Early signs coming that the Fed is ramping up for that U-turn. This is all one story. We're going to look back in 2030 and go, yeah, that's a good book. It's going to be really cool. So welcome aboard here as a new member. Appreciate that. Glad to have you here. Okay, so we talked options expiration. We talked Cathie Wood. We talked China. I can't understate how dramatic it is, what's happening in China. And one of the things that we have to remember is if you have exposure to the Chinese market, which you certainly do if you're in the chip sector or in the auto sector, is we could see some really rough months over the next 2 to 3 months here as China finally starts getting to some semblance of COVID immunity. I mean, listen to this quote. When I realized 11 out of my 13 colleagues were infected, my feelings were mixed. I actually hope I catch it this week because my work schedule is very full for the next 2 weeks. Oh gosh, that's terrible. But you don't want to go to work? I guess not. I guess people don't want to work. All right. China. Oh yeah. So another thing that China is doing now is they are also changing how they're reporting COVID cases. They're now only reporting COVID cases if you've been tested at a government COVID testing facility and you're symptomatic. So if you are not symptomatic and you are not tested at a government facility, you're not going to get counted. I guess in theory, if you're symptomatic and not tested at a government facility as well, you're not getting counted. So maybe it is and. Yeah, in order for you to be counted, it has to be at a government facility and you have to be symptomatic. So expect the COVID to rage in China, but the numbers to look low. Now, subway traffic is actually plummeting, kind of like what we saw in April to June. Red flag, remember the Shanghai shutdown we saw? Shanghai is just now starting to see a plummet in subway rides. You've already got some other areas like Beijing at basically April, May levels, low levels, plummeting. So subway ridership is a tool that's used for China as sort of a gauge of economic activity as well as mobility data to where it could be garnered, mostly because nobody really believes the official Chinese figures on what's going on. So that's quite interesting. Yeah. So those are some of the big things to pay attention today. Again, you've got quad witching. China's COVID story is a big deal. And obviously the potential for the large Fed U-turn eventually coming, a big deal. Let's go ahead and take a brief look at the pre-market here. We've got about 30 minutes to the opening bell. The big thing that I like paying attention is those bond yields. And very interesting that today, actually, the 10-year bond yield is sitting at about 3.5%. You've kind of been vacillating here. We've gone to like 3.4, 3.6, but we keep bouncing around 3.5 over the last week. No matter really what the stock market does, you're getting a lot of mixed feelings over here around that 3.5 level. Do keep in mind that this number staying higher is actually a good thing to some degree, because it lets the Fed feel like financial conditions are tight, right? If you start seeing Treasury yields plummet and they go to like 2.5% or whatever, you're not going to have very tight financial conditions. It's a problem. So what do we got here in the AM? We've got, looks like Tesla's up about 1% in the pre-market. Activision Blizzard roughly flat. Exact Sciences up 22%. AMC up 2%. Meta's up about 2%. DWAC down about 4.6%. Really, after that NFT release, really? Not that has much coordination, but it could bring people over the Truth Social. Open Door, rough day yesterday, along with Redfin and Square, down 5 to 7%, down about 1.5 to 2% here in the pre-market. Did look like Adobe released some decent numbers this morning. It's up 5% in the pre-market, which is interesting because you've been seeing a big SaaS slowdown. Although I personally believe that Adobe is another stock that still maintains pricing power. Got to get that PP up. So anyway, good luck today. Good luck on options quad witching expiration day. Hopefully you found this video helpful, and we'll see you in the next one. Goodbye, and thanks for being here.